Hello, world. How's
Hello,
everyone?
everyone. This is Mario Camino, my illustrious partner,
My little
and and I'm Danny Rivera with Arkad Capital. Some of you may know, some of you may not know. We've been in the business for a little over a decade and a half now. A lot of years. Well, I mean, yeah. You an extra 4 years beyond that, and me an extra 3 years beyond that. So combined, what, 30, 35, 36 years in the business.
So we did the math, and it's actually one of these slides, dude. It's altogether it's about 80 years. There's 83 years of combined experience between me, you, Adam, Paula, Pamela, Karen, and the entire processing team. I mean, we kind of just took everyone's numbers in there, and yeah, it turns out we're almost a century worth of knowledge.
Well, I'm half a century old, so I guess I'm half of that.
Yeah.
Well, so thank you everyone that's joining and watching us right now. As we just stated, we've been in the business a long time. We actually started as flippers and developers, and we still are. So we're very, very much ingrained in the business on an ongoing matter. You know, we buy anywhere from 2 to 4 houses a month and flip houses. And as of about 3 years ago, we started Arkad Capital with the goal of filling a gap in the marketplace for flippers, and that gap was honestly getting rid of some of the erroneous fees and the crazy rates at the time, and just getting rid of a lot of the BS at the time. We built our business using hard money and private capital, just so everybody out there knows. So we're where you have been, and we have achieved the level where we can actually help other investors out there hopefully get to our level and beyond. You know, well, hopefully not beyond. So welcome. That's Arkad Group and Arkad Capital in a nutshell. So today we're going to talk a little bit about what a lot of people are very interested in, which is BRRRR, right? We're going to talk about achieving wealth, but buying properties and holding. We do loans for fix and flip, of course, that's a given. But you know, holding is where it's at right now and where it's always been. That's kind of the end goal. So we're gonna concentrate and focus on that at a certain point. All right, I'm gonna stop talking now. I'm gonna let my partner do some talking.
Oh, Dick.
What's up, brother?
All right. So I mean, look, let me follow up this presentation. First of all, thanks everyone that's watching us, listening to us, and giving away some of your valid, precious family time on a Saturday to tune in and learn, educate yourselves, improve yourselves, and become a better version of you, as we all should on daily basis. Today is a special day. There's about 500 people listening to this. Some of the better top real estate investors in New Jersey are here today. So whomever's listening to this, kudos to you, and I hope you get the best out of it. As far as us go, as my partner mentioned, we are Arkad Capital. We're a byproduct of years and years of real estate development, house flipping, landlord, and combined with a bit of I guess call it Wall Street knowledge and financial knowledge. We reached a level where we could not just develop properties, but systemize the borrowing and therefore the lending system and process, and put it back out to the masses in a simple, understandable, profitable manner. And we did exactly that. We came on the market about 3 years ago. And since then, we've literally been racing a race of improving terms for those who come to us, for making for paving the way really for those who entrust us with their financing needs. And it's been an incredible journey. It really we've come up quite quickly, if you may, in terms of I guess of how fast a company should evolve. We believe in 3 basic core values that we've carried along from years and years of investing as well, which which begins with reliability. We believe being a reliable point of contact, a source of financing for your transactions is one of the most crucial aspects of this business. We want to be accountable. We want you to be accountable. And more importantly, we want to have a relationship where you know that we'll be there for you at the time that's needed with the capital that's needed. And at times with the structure that's needed. Lately, it's been a lot of that. The unique structure that perhaps most people that you talk to about this deal didn't understand or didn't want to put together, or who knows.
There's a lot of thinking out of the box that we have to do, especially lately. You know, with like you said, unique deals coming down the line. Also, just to add to what Mario just said, we also strive to create long-term investors. I mean, I think it's obvious that we want lifelong clients. We're not looking for one-hitters. With that being said, we tend to do a lot of I don't want to call it training, because a lot of our guys are very well experienced. But we do get heavily involved with our opinions in the deal. I mean, again, we have a lot of years of experience actually flipping houses, looking at scopes of work. I actually run the construction company for our flipping machine. So I get heavily involved in the beginning process and helping people sometimes hopefully save them money and make sure that they're going to do things right and win. The idea is to win and then be able to do it again in the shortest period of time possible, meaning buy your house, fix it, get the hell out, sell it, and do another one, or maybe 2 or 3 at the same time if you're at that level, and we can help you get to that point.
Right. So that really weighs heavy on the reliability factor. There are people that come to us rely on us for things like these. Perhaps they don't have all the construction experience that they may need, or they don't feel like they have it. They come to us for an extra set of eyes, an extra set of opinions on their costs, on their procedures, on their overall dynamics with contractors. I mean, the list of items is frankly endless. So that's where the reliability comes in many ways. The integrity, I mean, it's a very core basic of, I believe, any successful business, any good business. We do what we say we do, and if we can't do it, we tell you we can't do it. We really don't thrive on telling you or offering you things that we cannot do. And more importantly, once we've approved the loan, we hold ourselves at a very high standard to fund that loan. Once we've committed to something, we've never, in fact, I mean, I can say that by now, we've never gone back on a commitment in the past since inception of the company. So integrity is very, very important to us. And it's also important to be received from our clients. We want to work with people with a high level of integrity. At any given point, do what you say you're going to do is a mantra in this company. Growth is kind of, it's I believe it's one of the biggest common denominators we all have. We all strive for a bigger company. We all want more assets. We all want to do more loans. We all want to own more real estate. Unfortunately, most of us haven't fully figure out the steps to grow in something organically, grow in something with the right foundation, no pun intended. And through trial and error, we have, and we believe that we can bring that to the table within any given pipeline, within any given investor, and truly allow them to see what it looks like on this side, and how to set the right, take the right steps and set the right course to
set the right goals. Yeah.
A lot of times we get lost in we get lost many things. We get lost in translation. We get lost in overachievement. We get lost on sometimes we get stuck on stupid, guys. We really do. We know the next step. We just fail to take it. Sometimes we think too much. Sometimes we think too little.
Sometimes we think too little. Sometimes we think too big, right?
So it's good to have. We've always believed the added extra value to bring to any given client lender relationship is showing them real life experience and real mistakes that have happened, and giving them that side of us as a company, as entrepreneurs, as business owners, has always had a tremendous impact on the relationship we have with borrowers. They don't expect their lenders to tell them how to balance their taxes. In fact, they don't expect their lenders to ever have a conversation about taxes. So it's little things like those. It's
Building
it's
pipelines,
yeah,
how to keep your business going. We want to know what your goals are, of course. A lot of people come to us and they want us, they kind of have erroneous numbers, right? Everyone goes, well, I want to make $1 million. Okay, well, how are you going to make $1 million? So that's when we go, okay, if you really want to make $1 million, let's talk about how you do that. If you're flipping houses, you're starting flipping houses, and we start breaking down the process of what it takes. How many houses? What's your market? What's your average ARV in that market? Are you going to spread yourself throughout New Jersey and drive yourself crazy, or are you going to focus within a half-mile to 45-minute radius of where you live, which I think is super important. And a lot of people just kind of grab at everything, and you don't know a market well enough. Like I've been in this business. Me and Mary have been in this business long enough to know a lot of different markets in Jersey. It's very rare when somebody sends us a deal and we're not able to go, oh, well, that house, it's a split over here and it's worth 450. It's very rare that we can't do that. But that's a lot of experience. So most people that jump into this business really need to know their area and become an expert in their area. When we first started flipping, I'd say within the first 2 years, we designated, I believe it was 11 towns at first, right? We were just focused on these 11 towns, and they were very specific, and there were very specific types of assets in those towns, including micro markets in each one of those towns. So we're pretty nerdy with it from the beginning. So it's kind of in our blood. So when everybody talks to us and they tell us, hey, this is what I want to achieve, we kind of come from that level. We say, hey, you're going to need to buy this many houses. You're probably going to need to raise this much capital. This is what you have to do. This is how Arkad Capital can help you get there. Okay. Right. So you want to do it? Here you go. You got an issue with your credit? No problem. This is what you need to do to fix your credit in a month and a half. So we can do that. In the meantime, start building your pipeline. Get your houses together. Don't slow down. Don't speed up. Don't slow down. Do it this way. So we kind of help with those steps.
Hell yeah. So I guess the next slide that I want to show you guys is just an overall view of how we got to where we got with the private lending side of things. Our rates, our terms are highly competitive. We can go up to 75% of your future value. We can give you 90% of the purchase, 100% of the renovations. We move fairly fast, as most lenders, I believe. We average somewhere between 7 to 10 days. And we do drive-by appraisals when needed. I know that's it comes in very handy when you're doing sheriff sales, REO, or anything that's in a distressed type of situation where it's difficult to get the appraisers, or it's difficult to get investors or anyone inside the property. We can handle those. We launched, and we're nationwide, by the way. We launched this one, added value to our underwriting, which we dearly call perks, and we call them that because that's exactly what they are. They're added benefits that repeat clients of Arkad get. One of those is the most common of them is our deferred interest option. Meaning most loans that we have in our pipeline, and this is because most people really enjoy the benefits of this, have a deferred interest option for 3, 6, 9, or 12 months. Meaning you're not going to make any payments on that loan. We will make them for you for the next 3, 6, 9, or 12 months, which, needless to say, if you're running a pipeline of 3, 4, 5, 6 deals at a time, the cash flow the cash flow savings that this brings you is tremendous. I mean, we're talking about $10,000 to $20,000 a month in interest payments that you don't have to make. that would be made for you. So huge value to most of our clientele, and it's being utilized. And of course the other obvious, the deferred closing cost. If you need money for closing costs, we can handle that. If you need some type of assistance, some type of gap within your down payment, we can also help you with that. So I always say this to people, and things like first draw closing. I mean, these are all possibilities. But I always say this to people, and I say the best way to think of Arkad Capital is as a boutique hard money lender that has gap funding capabilities within it. And people kind of get it. They go, oh crap, got it. I know hard money, I know gap funding. You're both of those. And yeah, that's sort of the best way to think of us. And what this has gotten us in the past 2 years is this. This is our performance. I wanted to show it, put it out here so you guys get a sense of who we are and what we're doing. And it's about $60 million worth of loans in the last 2 years or so, with an average loan size of $242,000. Majority of our client base is here in New Jersey, about 85% of it. The rest spreads between New York and Philadelphia. We have 731 approved borrowers in our pipeline. We've sent out 1,200 POFs since inception, and our average rate is 8.75. Yeah, I know, right? I saw that. I was like, holy crap, that many? I mean, I literally sent most of those out. I had the original Word doc, and I didn't realize how many actually went out, but
we made some moves.
That's a growing number too. I mean, that's a daily growing number. And these are some of these are the basics of the loan. Not many different than most, other than we really extend leverage for good performers. We thrive on taking bigger bets than average on quality borrowers. And most of our client base is full-time, is composed of full-time real estate investors. Hardly anyone is part-time, or hardly anyone is doing this for I guess a hobby type of basis.
Right. 1 or 2 houses and then they're done for life.
Yeah, it's
they exist, and we're fine with those as well. But
yeah,
most of our rosters experienced ongoing pipeline investors.
Yeah, you know what happens? I think a lot of people get in, they get a taste, either you make it or you get out, and that's like a 2 or 3 deal, like 1 to 3 deal transition.
Yeah. You love it or hate it, depending on your first couple of experiences,
right,
or how hurt you got on your first couple of experiences. You hit it out of the park, you're gonna want to do it again.
Right.
You lose, you gotta think about it.
I wonder. I wish there was statistics being followed on this, like actual, figures on success and.
Yeah, we could probably put some figures together within ourselves for the next Expo, but we do have a lot of borrowers that started in the business with us, even started in the business as we were starting the hard money, right? And now we can be proud to say that these borrowers have become seasoned investors in the past 3 years. I've done multiple deals. Carla Mulligan and a couple of others. Her name comes to mind because she's one of our first, and she's on her like 6th house or something. So that she's awesome. We have a few stories like her. So again, we kind of, even if you're starting out, we're striving to build investors that are trying to make this a career. The ones that don't want to be the lawyer anymore, or work behind the desk, or the accountant anymore. They have dreams of flipping houses, becoming self-sufficient, and eventually owning real estate, renting real estate, and getting that residual income, that check in your mailbox every month, right? That's kind of, I feel like, the ultimate goal of many investors and many people that actually want to become entrepreneurial real estate investors. They want to own real estate. And then pass it on to their children, hopefully, if they do it right. And those are the stories I love. And then, let's face it, after a few months ago, unfortunate circumstances, a lot of the people that were on their way to becoming these landlords couldn't do it anymore. just because of the markets. And I'm not going to talk too much doom and gloom, but it's the fact. It's the fact, and it affected all the hard money lenders, every single one of them. And you couldn't go and become a landlord anymore. You're allowed to flip, but no, you can't. You can't do what the rich do anymore. You know, oh damn, okay. And everyone had to lay low, but it's back, right?
You are not allowed to build wealth easily.
Yeah, you're not allowed to build wealth. They're just short term, in and out, in and out.
Yeah, man. So why don't we? I mean, look, I always had this is always an interesting point for me, just because you know, like I guess it's like when you're not used to it, you don't really expect it the way the market kind of got accustomed to it. So like, I guess what I'm trying to say is most of the refinances we've ever done on the rentals that we have, both commercial and residential, have always been maxed out at a 70%. So fast forward to the market now, I mean, 70% is not necessarily what the audience wants, right? Like they got accustomed to the 75% on term or refi and cash out. Heck, there was 80% on purchase and term before. So the envelope got really, really pushed up, and very, very quickly. And this is really because of obviously Wall Street's influx in our markets. But it really changed the mindset of a borrower very, very quickly, where 75% became an absolute necessity. So when you're underwriting a deal from the beginning at a 75, markets change, and all of a sudden 70 is the new standard. That 5% could really hurt you, you know, because it's not just 5%. I mean, let's be honest, it's 5% plus closing costs, plus reserves, plus anything and everything else in between. And that could add up to easily 20, 30, 40,000. When we were doing these with banks, so before Wall Street came into this, we underwrote our properties at 70% from the beginning. There was no 75. And even then we had issues coming up with enough money for closing costs. You know, so I remember we opted
on the other way.
Yeah, dude. I remember we had to, sell off, and for every portfolio we did, we had to sell off at least one of those houses to have enough money in there, so we don't have to go into our own pockets. We'll make enough money in there just to be able to refinance, just to be able to give the houses. So, but it worked, right?
And that became a method for us. It's like, oh, this makes sense. Do 5 houses, sell one, we're all covered, we're good. Do it again, do it again, do it again.
You know, I said this to someone, and they were like, his answer was like, well, why would I want to do that? I mean, I want to refinance all of them. Like, I know you do. Yeah,
but we get rid of the one that's, you keep the pit bulls and you get rid of the chihuahua. It's okay. Right. I'm sorry for chihuahua lovers out there. But
he had a really hard time accepting that he wasn't going to refinance 6 houses, that he should just do 5 and sell off. So I guess that's what my point is. There is a shift in the mindset of a borrower, of a market. When a market changes, the borrowers are within that market. They sort of like change their mind and believe that this is the way it should be. And then there's a correction like this, and they're out.
You have to get used to the new norm, and you have to do it quickly, or else you're kind of just stuck in the mud, which is what happened. Stuck in the mud. I think also that comes along with, if you're really trying to grow a business, right? That mindset that you're talking about, like, why would I want to sell one? Why would I want to do it this way, right? Is because you're of the mindset, hey, I'm an investor. I want to keep everything. I'm trying to own everything, right? I want to keep it. It makes sense at the beginning. But as you grow and you become bigger and you own more property and you start looking at things from a bigger scale, and it's a definite shift in your mentality, right? Because we've been there. Everything we talk about, we've done, and we've been there. We've been that, I got to hold on to everything no matter what. That's crazy. I would never sell. We were those guys. But when you take that aerial view of your whole business, and I implore everybody to do something like this, when you just take a snapshot of everything you own, all your loans, and you put it in a spreadsheet, however you want to do it, QuickBooks, whatever. And then you figure it out and you go, wow, this is everything. This is the whole pie. Maybe if I sold that one, like, it starts making sense. There's sometimes you got to take a step back to grow and move forward. So that's what we did, right? So we said, hey, if we do this, that'll enable us to do 1, 2, 3, 4, 5. All right. That's a method, right? No, now you're not only looking at what you can keep. Then you start thinking in terms of, well, maybe I can do another deal, but I don't have to own all of it. I have some really good investors over here. Now we're actually friends. We've all made money together. Why don't we go on this together? Now we could do a bigger deal. So you stop becoming a hoarder, right? You start becoming that guy. Mine, give me. You stop becoming Scrooge, and you start going, well, we can all grow together, right? We can all grow together. Or I can make certain moves that are going to help me grow a little bit faster by doing something I probably wouldn't have done 3 years ago, right? So just different ways of thinking, changing your mindset.
Yeah, I think it comes with experience, and it comes with, frankly, just asset ownership, right? The more you own, the less this one particular house matters.
Yeah.
Right. Like it's one house out of 50 you own, man. It's gonna be okay. Like,
right. Well, lucky for us, we always looked at them, and we always used to call them little cash machines, right?
Yeah, man.
So if you got to sell one cash machine to buy 2 more cash machines, why not?
It's the way it works. But luckily for a lot of people, these programs are back, not to the full extent that there is no 80% anything, and there is no 75% cash out, but there's a 70% cash out in a 75% term, which is what I'm showing you guys here. That being said, within our 75 term, we can also roll your closing cost into it and not call it a cash out. So it really it serves at the very least the purposes of not having to bring money to the table, which frankly is just as important as how much of a loan to value you're given, how much cash out you can milk out of a property. It's just depending on which way you see it. Less money bringing to the table or more money coming out, in essence, is the same thing.
Right.
But so
what can you do with that money that you're not bringing to the table?
Correct.
So it's not really the same thing, right? Because you can use that money on another deal. You can leverage it. You can, So that's when we start talking about growth, right? And the mindset of growing your pipeline and growing your business, as opposed to just pouring all your money or into one bucket and getting that done and waiting, which is cool. I think everyone should do that at the beginning for a couple at least. But then you get to the point where if you're really going to do this as a business, you have to start thinking in terms of how do you leverage that money so I can do more business, okay? Because nobody does business by doing just one. You don't sell one Lego and make money. You sell thousands of Legos, right? You make and create, and then you sell lots of things at the same time.
Hell yeah! Speaking of Legos, I want to get a. Never mind. I'm getting Theo this big Lego thing. These 2 programs in front of you guys are the latest 2 that we have, which are making the phone ring like crazy.
Yeah.
The joint venture program that we launched about 3 weeks ago, it's quite powerful. We're looking at deals on weekly basis. These are New Jersey-based deals. But they're exactly what you're reading. In most cases, the borrower is not bringing any money to the table. We're fully capitalizing the project. We are involved in the project in a sense that we are advising consistently. We're not the final operators. You are, but we are bringing as much value to the table as we can with information and resources and obviously the financing.
Obviously, we want these projects to be successful. We want all of our projects to be successful, but if we're involved in a JV sense, of course, there's a little bit more oversight in a good way, right? We want communication, and we offer that as much as we want in return.
We also offer a good split. I mean, we put out a 50-50 type of split on there, but when it comes to joint venture, and I think the beautiful thing about it is that it's a venture, and there's not necessarily any defined parameters on how the money will be split without understanding each other's capabilities, right? So we are open to doing a 25-75, a 50-50, a 75-25. It really depends on the deal. The point of the matter is that we're highly active with this, and if you have a reasonably profitable deal, and you can take it down for whatever reason, we're very much there to get this going. And because of our structure, because of our infrastructure, we're very quick, and we're very able to take down, frankly, any size deal. I'm talking on the residential side of things. So that being said, we are selective about this. We are not doing ground up new construction. If we're gonna do an at a level, we're quite picky as to the location and the amount of square footage added to that property.
Yeah, as well as the qualifications of the borrower to get an at a level done. Let's just be straight and fair with that. This is all well and good, but the experience of the operator also count, so we have run across a couple people that have absolutely done nothing, and then they come to us and say, well, I want to build a brand new 5,000 square foot house, and that's a little tough. You've never rehabbed anything. We're not going to get into you adding 1,000 square feet of footage to a house. You shouldn't be doing that. You're going to hurt yourself, unless you have a partner that's done it, and so there's caveats to that. And that's when we start talking about the differences in split and who's going to bring what. But the bottom line is we're deal makers, right? So you bring us something, there's money in it. We'll tell you what we feel, how it should be structured. We'll listen to you, you listen to us, and then we come to kind of a meeting in the minds, and we get it done or we don't. And that decision is usually made within 24 to 48 hours. So it's really quick. So we're not holding on to your deal. If you want to go make something happen, you can make something happen if we're not into it. So I just wanted to put that out there as well.
Yeah, I mean, so far so good. A lot of the deals that we've seen are somewhat okay. We've had issues with some of the potential partners. Information that wasn't fully attained until later on in the transaction. So all the basic, I guess, rookie mistakes that sometimes you wouldn't expect in this, but it's very
very important in this business.
It's very much active. The other program that we launched actually this week was the large multifamily program, which I'm looking forward to really not only underwriting and funding, but I'm also looking forward to utilizing myself. It's quite flexible. It goes 5 to 50 units, but frankly, if there's more units, it's also there. The cap is really in the $10 million range. The max loan to cost on this is 80%. So why is that important? What I'm telling you is that we are financing apartment buildings with you put in 20% down. This is assuming the building's occupied. There's no value add. There's no construction. It's just you just found yourself a good apartment building, and you just want to buy it. So if that's the case, we can do it with 20% down on whatever purchase price you got the building for. Rate is generally 10% on this, and the closing time is relatively the same. It's 2 to 3 weeks, same as the multifamily, the smaller multifamily. This product is pretty strong. If you do need renovations money, if you do have a value add play in your hands, we will look at it as well. The loan to cost changes a little bit. It goes down to 75, so it's 5% less. But we will finance you 100% on the renovations cost as well, up to 75% of the loan to value, the future loan to value. So just very much like a flip. We will give you the capital to fix it. We will stabilize the loan afterwards, and you get to keep this thing for 30 years. So really strong product, and New Jersey happens to have a lot of apartment buildings. So and it's one that's coming back by popular demand. It's what you guys have been asking for quite a while. So if we were making landlords before, I think it's fair to assume that we're going to be making the same landlords, if not new ones, play at a much higher level within the next 6 to 12 months. And so
absolutely.
So
with the migration that's quite obviously going on right now. I'll call it obvious. It was questionable a couple of months ago, but we're seeing the migration from New York, and you're getting buyers as well as renters coming to the market. So apartments need to be filled. people are going to be looking.
Yeah, man. There's gonna be a big wealth transfer of wealth on that end too, because a lot of apartment buildings in, let's say, the Jersey cities of the world, and the Hobokens, Weehawkens of the world, they're quite pricey, and they were able to get built and financed because of the high expectation of revenue.
Right.
Without the high expectation of revenue, a lot of the pricing on these apartment buildings is gonna fluctuate pretty severely,
which is gonna bring some opportunities to the table.
Correct.
Everyone should be looking out for. When it counts is the question, but you have to be ready.
Yeah,
it'll be fast.
I'm confident. I mean, look, I was in Jersey City last week, actually early this week, and I was actually showing a couple apartment buildings where majority of the tenants have left already, and you can actually see it. You can see a lot of empty windows.
Right.
The person who I was with, the apartment he had because he's moving too. He's moving out. He's moving down the shore. His apartment building dropped. The cost dropped by like $750.
Wow,
which is insane. It's like an apartment in itself.
Wow.
But the original asking price was $4,700.
Right.
So what is $700? I mean, it's still a $4,000 apartment.
Right.
That not one person, not one out of the 4 roommates that were there is able to upkeep with. So yeah, so they're moving out. So if that's happening there, I mean, this is happening across the board. So I think this product that we have is gonna come in and finance a few of those purchases.
Yeah. Eventually, people are going to want to move back in. Something's going to happen. Something's going to shift. As hard and fast as this came, it's probably going to go. Hopefully, sooner than later, right?
Yeah, man.
Talking COVID, of course. But when that does happen, you're going to get people moving back in, and then you're going to have those rents increasing over time. And somebody very smart and intelligent that took advantage of the Arkad program, hopefully, would be the ones to purchase those buildings and reap the rewards over the next 10 years, 20 years, 30 years, for the new increases in rent. It's like the stock market. It goes low, and then you buy low, and then you ride it back up. But you're just doing it with rents. So somebody's going to do that. Keep a watch out. Be prepared. When I say be prepared, get an application and talk to us, tell us what your goals and dreams are, and do that process and be ready to purchase. We'll give you the tools necessary to put offers on properties. That's the most important thing. And I'm talking to you experienced guys out there as well. Now we're talking big boy stuff. We have a lot of experienced guys that buy nothing but 2 families, 3 families, 4s, and that's kind of their forte. Well, now we're talking about more units, now we're talking maybe you should be looking at the 10 units, the 15s, the 20s, bigger stuff.
Hell yeah.
Stuff you only dreamed of. It's coming.
So I got this testimonial just to wrap up our presentation. Well, actually, no, I'm going to do the samples, but I got this testimonial I wanted to play for people. Talks about us, what we do, and how we do it.
Hi, my name is Rosa Brooks, and I wanted to take a moment to extend my deepest appreciation and gratitude to Arkad Capital lenders who helped secure funding for my latest project. And especially thanks to Karen Ortiz, who have made every transaction smooth and easier. I couldn't have done it without you, Karen. I would highly recommend anyone who's looking to secure funding to check out Arkad Capital. You guys have made my dream a reality, and I am looking forward to doing much more business with you in the future. So keep up the good work, and thanks again for everything.
Love that.
She's great.
How could you not love that, right? So she mentions Karen Ortiz, so we got to give her a big plug, of course. Karen Ortiz is drums up business for us. She's our head of business development. And you know, she interacts a lot with our borrowers. So needless to say, if you do sign up with us, get into the fold, you'll be dealing a lot with Karen, as well as me, Mario, and Adam, and other individuals. So we have a really good team, and we all really care about your success. You know, that's the bottom line. We care about your success as much as we care about ours. We take it all personal. We take real estate very personal and very seriously, and we want others to kind of benefit from our knowledge. A lot of people call us the gurus that don't ask for money, right? The gurus that don't sell packages. And at first, I think it kind of bothered us because we didn't like being considered gurus, because there's a negative connotation to it in a way, you know. But yeah, you know, we are always giving out advice. I think more people have our cell phone numbers than should, and we're always texting with clients and people running things by us, and we actually enjoy it. You know, we live by that. A lot of texting, because if I had to talk to everybody every day, I would get nothing done. But and Mario as well. But yeah, that was heartwarming, and that was a good way to end the week. That was just given to us this week, unsolicited, and made us extremely happy. And that's what we strive to do.
Hell yeah, man. So I'm writing this little example of how we look at deals. Just a quick equation that should be able to help people. I guess if you're out on the road and you just want to do a quick analysis, this is what you should be doing.
This is the non-spreadsheet analysis. Quick, down and dirty in the field. Get it popping.
Correct. So your three basic components: your purchase price, your renovation, and your ARV. Always most important three numbers you'll need to figure this out. Step one. Always know what your max loan will be, just so you're comparing apples to apples. 65% of 400,000. Yes, we can go to 70%. Yes, we can go to 75%. The closest you get to that 75%, the less likelihood you are to succeed on that given deal. Plain and simple. So
whether you get financing or not.
Correct. Financing is irrelevant. You can get all the financing in the world. Point of the matter is just historically factual, repetitive. The closest you get to 75, the less likelihood you are to succeed. However, depending on the size of the deal, they're higher or lower. Point of the matter is you should really underwrite your deals at 65 and work them higher from there if needed. 200,000 is your purchase price times 80%, meaning what? Meaning you are putting 20% down. We are giving you 80% of the money. You are putting 20% of the money. 200 times 80% is what you're being financed. Is $160,000 that you're being given on the purchase price. Mm-hmm. You take those 160 and you add 50,000 for reno that you had up here. Your total loan now
is a great average. Just want to say there's a reason why we say 50. Of course, it could be 40, it could be 50, 55, 60. Those are the numbers you have to play with after you view the house, right? After you know what it is you're dealing with. But 50 is your good down and dirty number if you're driving by.
Correct.
Sorry, man. I just want
when you take no, please. I'm trying to write these numbers, so if I miss anything, by all means. So then you take the $210,000 loan amount and you divide it by the potential ARV you have. The number that you're gonna get in this case is 52%. 52% is a far better number than 65%, and 65% is a far better number than 75%. Therefore, this is a hell of a deal. Anything between 50 and 55% loan to value, heck, 50 and 60% loan to value, you're in good shape. Now, a few tricks of the trade. Let's assume that you had some questions on that 50,000. Let's assume that you perhaps think that you could use a little bit more money. What this equation is telling you that, yeah, perhaps you could do more than 50,000. Let's try 70,000. So $20,000 more added to your budget. So the same math applies. You go back to the figures. The only thing that changes is here, you're adding 70,000. So 160 plus 70,000, you're at 230,000. 230,000 divided by 400,000 gives you a 57% loan to value, or a LTV. It's still a hell of a deal, and you just got yourself an extra $20,000 on your scope of work to be able to perform. Now, you may or may not use all those 20,000.
Try not to.
Right. But you have it, and there are ways to structure your scope of work, your budget, your overall structure, for you to be able to capitalize from the extra equity within your deal. And that's a conversation we can have based on it. This is really the sweetest, simplest way for you to be able to have enough in there to not find yourself in a pretty crappy situation.
Also, another thing I want to point out about that going from 50 to 70, and that is actually something that happens all the time. There's always something that pops up. That furnace you thought that you were going to be able to keep because it still looks shiny, all of a sudden doesn't work, right? Because it was submerged in water and you didn't know that. Now you have to replace, and there's $5,500 you got to spend, or let's say my cost $3,800, right? Because I have relationships. But the bottom line is you got to spend a little extra money. But every dollar you spend above your original budget is just basically coming out of your profit. You could look at it that way. That's $20,000 more that should be going into your pocket that you're pouring into the deal. So sometimes you have to, but again, the goal is to not, right? The goal is to do enough to make your house sellable in the market that you're working, meaning don't overdo it, don't underdo it. That's an art in itself. And that's also something that we help a lot of our borrowers with, especially the ones that have only done a couple of deals, what to do and what not to do. You don't need radiant heated floors throughout the whole house if you're selling a house and your ARV is 380. You just tile. That's what I'm talking about. You don't have to overdo it and act like it's your house that you're moving into. So the money's there. You use it, but only if you need to.
Now check this out. This is a very common example here in front of me, and I feel like it's right to bring it up. The same exact deal that we just did, but you add a wholesaler fee of $50,000, which, by the way, the borrower forgot to tell us in the front end. So we underwrote this deal under the wrong numbers, the wrong premises, right? But let's assume that he brought that up, small factor that can make or break a deal. When you add that wholesaler fee to this, now you're borrowing now you have a cost basis, a purchase price of $250,000. If we do the same math we did before, your loan just increased to $270,000, even though you have that extra padding, right? Well, $270,000 divided by 400, your ARV just crossed the 65.
Right.
You're a 60.
Now you're in a danger zone.
So you just put yourself in a danger zone because this wholesaler is making, frankly, a big portion of your profits.
Right.
So what to do in this case, Dan? What do we do in this case?
In that case, if it were me, which a lot of times it is us, we're renegotiating that fee. It is what it is. So listen, this comes with a caveat and disclosure. We do not hate wholesalers. Wholesalers are important to the business. They find deals that other people don't. That's their business, and that's what they need to do. We do have a problem with wholesalers that tend to carve out most of the profit out of a deal and then try to give it to another investor, usually an investor that hasn't done a lot of business and they're dying for a deal. So we tell people to be careful. But a reasonable number for a wholesaler to make on a deal, 10,000, 15, maybe even 20 on a banger. But if they're making like a ridiculous, they're making more money than you're going to make, and you're going to go through 6-7 months of hell to get this done. And let's face it, they did some marketing. They were very good salespeople, and they were able to get in the house and get a contract that they could flip to somebody else. There's work involved. That's a skill, but nowhere near what you're going to go through renovating a home and putting it on the open market and dealing with townships and COs and all the stuff you're going to have to do to get this house done. And there's a value, there should be a larger value to what you do as the investor is what we're getting at. We are seeing a lot of deals come across the table where the spreads, even in this market, which is crazy, where the wholesalers are really just trying to make a killing. and it really needs to kind of calm down. We think it'll be regulated, but unfortunately, people are getting hurt first before the numbers change. They're buying the deals, and then they're not being able to sell them at the number they think, or they're not being able to get it done, and they're not making money, and then they're getting out of the business. And the wholesaler gets to go on their merry way. On the other end, the wholesaler can never sell a house to that particular purchaser again. So I just think it's counterintuitive, you know. But so anyway, I just kind of wanted to throw that out there. What would we do? We would be renegotiating that deal. I mean, no matter what, the numbers are off. It becomes way too risky at that point. And when we tell a borrower, hey, this deal is risky because of what you're paying, plus the wholesaler fee, you really got to look at where you can chop that money, and it's usually the wholesaler.
Yeah, it usually is. It's usually not even the budget; it's the wholesaler.
Correct.
So chop this down, make it work. The other one is, it's quite simple. The rental underwriting. I mean, look, this is, you know, third grade math. Frankly, you're multiplying whatever your as is value right now as is. Because this is under the premises or the notion that you have completed the rehab on the house, or you're buying a house that needs no rehab. So there is no rehab component on these rental loans. There is a two-step bridge with a fix and flip on the front end and a takeout on the back end, but there is no rehab component within any given loan. These are rental loans for long-term holding, not renovation loans. So the idea is you either have a property that needs no renovations, that's already rented, that you just happen to buy because it's a great deal, or you found a distressed property that you fixed up, you rented, and now you're ready to refinance. Those are usually the two main scenarios. Regardless of what the case may be, the now value of the property, we will take that value times 75%, and that will be your max loan amount. If you're buying it, you're bringing 20 to 25% down to the table to make those numbers work. If you refinance it, you're taking 75% of the value, and that should cover your balance. In this particular example, the balance is $200,000. Your refinance max loan is $225,000. Your closing costs are $10,000. You have about somewhere in the ballpark of $10,000 left. So this is what's known as a cash out.
The famous cash out.
Okay. Now the amount that you're taking out, I mean, 10,000 is money if needed, of course. But when it comes to money like this, you know, 10,000 is not gonna make you rich. In many ways, I prefer to just leave that type of money in the deal.
Leave that equity in your home. Keep that equity. Keep it.
And move on. So this is the scenario on a rental property. So very easy math, very simple ways of figuring out where you stand and how you can get these done. Now, there's a couple other factors on the rental loans, like a DCR, debt coverage ratio. They're very credit based. So the best bet with these, at least for now, at least until you own a couple rental properties and you understand cash flow, you understand just all the risk mitigation that happens in between, then you venture these out on. I've been venture out completely on your own, but until then, we're usually a phone call away to run a quick sample on one of these and give you literally, I mean, every detail of the loan. So we're a phone call away for that.
Yep.
I pretty much went through the whole thing, man. I'm gonna leave the main page on there for questions and answers. I guess let's wait out a little bit to see if there are any.
Yeah, anybody has questions, flip them out. I'm gonna put another screen up real quick too, because I like to pop up our QR code, because everything Mario's talking about, of course, is on our website, and obviously if you Google Arkad Capital, you'll find us, but you can also click on that QR code, or just wave your camera at it. As you know, QR codes work. That'll bring you right to our website. That'll list all the current rates. Rates and programs are ever changing. We're constantly working in the background, constantly working to get the best terms, the best rates, the best deals possible for our clients, and quite frankly, ourselves. So constantly visit the website so you can get the most up-to-date programs. How do the questions come in? Or people enter?
Yeah, no real questions. I guess it's on Facebook Live, so I don't. So I guess we'll wait it out for a second, but yeah, man. Shout outs to our team. We have a new employee starting this week. Shout outs to Karen. Karen's doing well. Andrew, Lene, our processors, BS Milde, Adam, our partner. Shout out to the whole team. I wish things were different. I mean, normally speaking, we're all bunched up in a hotel.
We'd have a big room. We'd all be dressed up, pressing a bunch of flesh.
Yeah.
For the next 4 hours, right? Which I kind of miss. Those are crazy days. I'm sure they'll be back. This is an interesting way to do it. I want to thank Nick Tang for throwing this and you know coming through with an event that probably only he can do at this scale anyway. We've been doing our happy hours for a while, and they work and they do well, but nothing of this magnitude. Speaking of which, I might as well just throw that up there. You know,
yeah,
the happy hours that we do every Thursday on Facebook Live from 4 to 6 o'clock.
We have a bunch of questions. I completely missed them. Here on this side.
They're all right. Let's answer questions. Let me
all
get
right, so cool. Always great to hear from these guys. Christopher Chen, what's up, man? He's a realtor, I believe, with Keller Williams. Good guy, active dude. Does our areas actually, well, former areas on the luxury side,
Mm-hmm.
the
Chatham's and Summit area.
So good stuff out there, man. Best of luck. Hope those markets are holding out well. What do you guys see? Student rentals in 1-2 years will need space for increased demand for new options, or will it go down as everyone will be studying online? Dude, great question.
Ooh, great question.
Elvis Nasi. Crap, man. I was actually at Rutgers 2 nights ago, and restaurant in New Brunswick, and this question came up. Since I mean, there's actually a couple new buildings in New Brunswick that were recently built to cater specifically to students, and they're sort of on the higher end of things. You know, the answer is not a simple one, because I'm not exactly sure how universities or what universities are gonna try to do to keep some of those students. But it's two separate worlds, right? Like I think dorms are gonna become more accessible than they were. I think that the apartment buildings that are designed for student housing, so off-campus housing, not dorms, not college-owned dormitories. I think those guys are going to take a real hit. I think those apartment buildings are gonna suffer. There's not the high rents that they have been accustomed to charging is literally diminishing by the minute. And I think colleges are probably going to create some type of incentive to be able to retain some of those students in their dormitories, even if those dormitories have to become single apartments rather than doubles or triples.
Just as a business, you know, it's something they have to do because they have all this empty real estate that they're maintaining. They're going to have to do something, even if they could just break even on their maintenance. And now, let's face it, cleaning costs, right? And costs just to keep everything sanitized because of COVID. Whole new world, whole new thing that we're dealing with now. It's gonna. I could see the government coming in and saying, "Well, this is what's going to be mandatory." It's going to become like almost like new OSHA requirements or new handicap requirements, right? There's going to be now cleaning requirements and special lamps and all kinds of stuff that is probably going to come over the next couple of years. that is all translates to money that has to be spent and has to be covered. So you have to at least break even on that before you can get to a place of making it profitable. So I agree.
There's a lot of liability too, dude. Like from college, like colleges don't want to take the chance of a kid dying with COVID. You know, it's just bad business. It's not something. It's very. And for that matter, you know, so same thing with these luxury apartment buildings. You know, that like New Brunswick is a great example. There's 3 of them that are up recently within the last 2 years. That, I mean, their rental is the rent's ridiculously high. I mean, we're talking $3,500 to $4,500 a month to live in New Brunswick. So I think that market's really going to take a big hit when it comes to this, which, you know, when it comes to that, all that means is that those landlords are going to have to allow for tenants that they would otherwise not, meaning subsidies, meaning, you know, lowering their rents, concessions, and so on.
Yeah. And they might have to, you know, change, retrofit them a bit, you know. A lot of these, if they're like set up like boarding houses, they might have to change layouts. I don't know, really depends on the market, right? They might have to do some things to these rentals to make them attractive to a different market other than the student market that doesn't care because they're only there a few months at a time. I mean, I'm talking, you know, New Brunswick, some of these houses over there, they look great in the outside. You walk in and they're hell inside. And these kids don't really care how they live, right? Because they pay their rent and they just party and study. That's all they do. So they don't really care. But some changes are going to have to be made. That real estate will become valuable again one day. I'm not saying it's going to be dead in the water. Hopefully, you know, everybody hopes there's a vaccine and this and that. We're talking something totally different. You know, and say, oh, everything's back. You know, everybody's running back to school. But we're already seeing the writing on the wall. There's already colleges that are already talking about going fully online. And a lot of the parents are actually pushing this, right? They're like, they don't want to send their kids back. My child's home already. Let them study online. But here's the funny thing. Most of the colleges, especially the bigger ones, are not really lowering their prices. So they're not changing their pricing structure. You still got to pay the same tuition, whether you're going online or whether you're meeting your professors face to face, which is crazy to me.
That's ridiculous.
It's ridiculous, but it's happening. And why can they do that? Because most of them are private institutions. They can do whatever they want, right? So only the market can change that. That will be people going, no way am I paying that. My child is not. If they're going to go to online school, they're going to go to University of Phoenix because, right? Because they've been doing this from the get go, and they probably do it better than you anyway. You know, I mean, and that's going to take time. But the bottom line is that business is going to be highly affected, and and I believe eventually it will create opportunities in that space. You know, where vacant units create opportunities. Somebody's going to get creative on it and figure out how to rent these units, and prices are going to have to come down. It is what it is. So again, the transfer of wealth that Mario was talking about is what's going to happen. Oh, Gianna had a question. Hi, Gianna. Thanks for joining. She says she wanted to know if a rental needs to be vacant in order for us to finance. And the answer is no. But, you know, it's no but preferred is the answer, right? Because
depends on what you're
vacate these units in order to take them down.
Yeah, no, it really depends on what she's talking about.
You're right.
I don't know if you're saying a rental or a fix and flip, but frankly, vacancy and occupancy is defined by the legal right that person has. So if you're talking about a tenant with a lease, it's a much very different conversation than a tenant without a lease. Correct. If you're talking about an owner, a former owner that is still living in the house, let's say a foreclosure happened, the family or whatnot, they're still living in the house. That's a different conversation than the one with a bad tenant, right? So my answer to that is, I mean, like Dan said, we don't need a vacant house to finance. No, we don't. Whereas I believe a lot of other hard money lenders will not finance a sheriff sale, for example, I heard, if it has people in them. We not only buy sheriff sales with people in them, but we finance dozens of these things with people in them because because that's sort of the reality of the world. You know, like when people get foreclosed, they're not necessarily, you know, even in tune when they have to move out. They haven't been,
Yeah.
you know,
Some of them have their head in the sand and they're just like hoping that you know, the skies open up and says, oh, you're okay, you don't have to go anywhere. And
right.
then the foreclosure happens and they're like, oh my God.
Yeah.
So you have to know how to deal with those people. And they're, like you said, there's different categories.
Yeah. So my point is, no, we don't, they don't have to be vacant by any means. But it's definitely a piece of the puzzle. It's a piece of the equation that not only we have to know, but you have to know. And you have to know, because it's what's going to determine your entire process. You literally from beginning to all the way to your exit. And more importantly, it's going to define your timelines. And defining your timelines is sort of the backbone of success in this. Meaning, you know, once you've crossed a certain amount of months owning that property and haven't been able to accomplish anything because of the bad tenant or former owner or whatever the case may be, your chances of actually succeeding in this relationship, being successful in this, it start to diminish. And statistically, that starts to happen after months 7 and 8. Your chances go down every month more and more and more and more and more, to a point where the property has no equity. It has no upsale. It has no resellability gain, and you're out. You did an entire. You took a big risk. You did an entire deal. You did all this for nothing, for zero, or worse, for negative, you know, 20,000, 50,000. So, occupancy is not an issue for us as a lender. We've literally structured our company so it's not a problem. Example, we have drive-by appraisals. So when we came out with with drive-by appraisals, when we came out with drive-by appraisals, a lot of people were looking at us like, what the hell is wrong with you guys? Like, you don't even care what's inside the house. How do you not care what's inside the house? And our answer was like, well, it's not that we don't care. I mean, of course we care. But we've done these deals as investors. We've done share of sales where we've bought houses sight unseen. We've taken those chances and we've come up with our own formulas to win. Where, I mean, look, Dan can elaborate on this, but we call it X-ray vision, right? Like we go and see these houses. 95% of the time, we're not seeing the inside of this house, but we are seeing is the outside, and we are seeing the dimensions of the outside. And maybe
we're seeing the maintenance of the outside,
right?
To give you a clue to how well they maintain the inside, 98% of the time.
Correct. And that gives you a sense of experience at a level where, no, you don't have to necessarily get inside a house as long as your projections are sort of plus or minus within the range of what's this house actually going to cost. Now, the way we do it is based on square footage, right? Like we know what a basic cost for a house per square foot is. We know what a little bit more extensive rehab is, and we know what a troublesome rehab cost is.
Right.
So what we do is we've gotten great at being able to see these houses and really in many ways just guesstimate the amount of work that we'll have inside. Is it always perfect? Absolutely not. Right. But it's perfect somewhere between 80 to 90% of the time. And that's what matters.
And bringing it back to pipeline. So people go, oh, that's crazy. That's a lot of risk. It can be a lot of risk. It can be a lot of risk if you're doing one deal, if you're doing 2 deals. But if you're spreading it out and you're doing numerous deals throughout the year, you're minimizing your mistakes. You're gonna make a mistake on a couple of those if you're doing it right. Right? It is what it is. You're gonna get hit with some kind of surprise, some kind of mistake, but you're leveling it off with the rest of your deal. So you're looking at your overall company. You know, no major company bases their profitability on the sale of one item. Let's say you're selling an item, right? You don't base it on the sale of one of your sales. You base it on what did I do throughout this year? You know, how many of these things did I sell? How much did it cost me to produce them? How much did it cost me to market them? How much did it cost me to sell? And what was my profit? You go by that. If you're only doing one and you make a mistake, you know, then that can hurt you. If you're doing a few, then you're kind of evening out your results, and you're batting maybe not 1,000, but you're batting 980.
Right. So I guess just to sum up the answer, Gianna, great question, by the way. So, yes, we finance them. No, we don't need them to be vacant. Yes, we do drive-by appraisals. But whenever you find yourself in this situation, let's look at the entire picture.
Yeah.
As to how to go about it. Like if it's not vacant, we can show you how to make it vacant.
Correct. That's when you really, really ask us and use our experience. And Gianna is actually good at I'm on text basis with Gianna. She's gonna do something. And she can ask me a question like that, and I can say, well, this is how it would handle this type of occupant. I won't say tenant because they're not always tenants, right? Sometimes they're owners. But this type of occupant should handle this way. Maybe it's cash for keys. It's a speed thing. Just offer money to get the hell out. There's lots of ways to do it. Or you do a straight up eviction because they're a tenant. They don't have a lease. Or you got to wait out their lease. You might not want to do that deal. Or their lease is up in a month, and then maybe you do do that deal. So gaining information. Buy out their lease. You can buy out their lease, which is another form of cash for keys. Or you could do what they call an ejectment, which is what and that works in Jersey. It's been working. Of course, right now with COVID, nobody's evicting anybody, so things are tough. So you have to look at the deals from that perspective also. If you're getting into something that's occupied, it's going to take you longer to get them out usually. So cash for keys is probably your best bet right now.
Look, that's a class in itself that I don't think we're even.
Yeah. We might get into that. I'll spend another hour on
it. All right, so let me jump to another one. Yamari Carasquillo. I have a question. Besides experience and credit, is income playing a big part of being able to obtain a loan? No. So, I mean, look, I love dealing with people that have $50,000 in a bank over people that have $5,000 in the bank.
Well, having money is important.
Right.
How much you make during the year is not really that important.
Correct. So the idea with our programs is that the income portion of the underwriting really comes from the deal itself. It doesn't necessarily come from you. What's needed from you though is to meet basic credit and background requirements. Depending on the level of experience, we might want you to put up some money for payments in advance in case you default. Hardly ever, though, that happens. And ultimately, the money that's needed for the transaction from you is your equity, right? It's your 10, 15, 20, whatever percent you got to bring to the table. That's the money that's the only money, frankly, that I care about. And I care about that money because that money gets matched up with our money on the purchase. And collectively, we're able to buy this property. But because of the fact that you put up the money, again, statistics, right? Statistically, you're more than likely to follow through with the deal. So, no, we really don't care about your income as much as we probably should. We care more about your credit. We care more about your experience or lack thereof. And ultimately, we care about the deal itself. The deal itself holds somewhere around 40 to 50% of the weight on our decision making on lending you money on any given deal. So
the ARV and the repairs and your purchase price.
Correct.
Get those right. Get those right.
Oh, sorry, Christopher Chin moved to Nest Seekers. Nest Seekers with, isn't that Brian? Ryan, $1 million listing, Ryan.
Mm-hmm. Oh yeah, that's his. That's
good marketing. Dude, that's a great name, by the way. Nest Seekers.
Yeah, Nest Seekers.
Brilliant.
Good for you, Christopher.
Yeah, man, big moves.
Mark Thompson.
We our CFO. I mean, maybe I shouldn't be saying this, but our CFO, one of his close friends, works for the capital management firm that manages Ryan's money, and well, not his money, his team,
right.
The realtor revenue, marketing expenses and all that, and the numbers are gigantic, and the guy is a beast, and it's definitely a good leader model to follow.
Yeah.
Anyway, so let's jump on to this last question. Unless anybody else has any other questions, the last question is, what's the minimum requirement for a Harmony Loan credit income DTI? We don't care about DTI. It's we do care about inconsistencies in your credit, but we don't necessarily base it on DTI. The minimum requirements are a 650 FICO for fix and flip and a 680 FICO for rental. As far as your background, we unfortunately do not do business with people with questionable issues, crimes, financial crimes specifically, and fraud and so on in their background. Global watch lists are in place. So generally speaking, we don't any major crime that has happened within the last 10, 15, 20 years. We really try to stay away from getting involved with those type of borrowers. So if you're not a criminal and your score is fairly decent, you qualify from that end. On the other end, it is really a matter of qualifying the property. Experience, like I said a little while ago, I mean, we do deals with people that have 0 deals in experience. We finance people that have 50 deals in experience. So it's not experience is a factor, yes, but that gets complemented by the amount of money that you have to bring to the table and the type of rate that you have to pay. But other than that, we welcome you. Your income, again, as I mentioned, it doesn't necessarily take a factor into this. So, you know, overall, the idea is for it to be asset based. So we're not necessarily putting the biggest emphasis on you and your credit. We want to know about you. We want to know that you don't owe creditors millions of dollars. We want to know that you're not a criminal. We want to know that you know, you don't owe a lot of people a lot of money and they're all coming to get you, kind of thing. But other than that, we're not necessarily looking for anyone that's 100% super clean or anything like that. We want to know that frankly, we just want to know that you're a good individual, and that if we are going to make a bet on you, that we have a pretty good chance of getting our money back. That's really it.
That's it.
It's really everything else just technical BS and mumbo jumbo, but the reality is, look, we're good people, and we consider ourselves good people. We're family, man, and we wanna be able to sleep at night comfortably, and we want to be able to know that the people that we're making money with are also good people, and they also have a good head on their shoulders, and they also have families to provide to. So that's really it. It's a matter of just feeling good about who you do business with.
Yeah.
So. Anyways, any other questions? Anyone else? I'd love to answer them.
He said, "Thanks, I'm safe."
Good, man. Look,
man.
most people don't have these type of background issues. Like if you if you committed fraud or something crazy like that, like you probably shouldn't be in real estate in the first place.
Yeah. I mean, you could try, but you gotta maybe do it through a partner or something like that.
Especially now, like things have changed so much. Now, like background and credit, it doesn't matter where you go, you're gonna be looked at.
Yeah.
Joint venture, private. I mean, if you're private lender, you know, that just gives you money and doesn't check anything about you, good. I mean, hopefully you have a good track record with these people, and that's what makes a relationship solid. But if you're building a new relationship and you're going through this and no credit is pooled, no background is known, I mean, it's just not conducive to anything positive at the end. I mean, there's it's the era of information.
Yeah. And
we have the ability to gather information, so we should use it as intended to. Awesome. And that's it. I mean, same for you guys out there. If you ever take on a partner, you know, ask for credit, ask for references. It's important to know where the money's coming from. There's a lot of illicit money in this world, and knowing how it comes to you is important. But other than that, we're here. We're happy to be doing what we're doing. We still very much buy houses and apartment buildings, and we still very much lend to other up and coming real estate investors. So I believe our purpose is pretty clear. I believe our purpose is very honorable in many ways, and I believe that by doing what we're doing, we're making an impact. We're having an impact on a lot of people's bottom lines. And I'm not just talking monetarily. No, money is sort of the icing on the cake that comes when you do everything, when you do your baking right. So I'm not really just talking about money. I'm talking about progress. I'm talking about growth. People that couldn't think or didn't think they could or couldn't or believed it was too much are now people that are buying their first luxury car. And I love seeing stories like that. There are people that are now no longer just thinking about flipping or hopefully flipping their first or second house. Now they own 3 rentals.
Right.
So that is truly what gets me out of bed when it comes to this lending thing is the ability to have an impact on people's lives ongoingly, for years and years to come. I want people to think of us as those people that gave him the first push. And if I'm in business, or I plan on being in business 10 years from now, I want to be able to reach out to those people who are no longer starting, who have massive portfolios, who have incredible operations going on, and being able to exactly, dude, reach out and extend my hand and say, hey, you're a big guy now. I'm a big guy now. Why don't we do something even bigger?
Do something, right? Yeah. So yeah, I was just about to say that. So sometimes it drives me crazy how in tune we are, and it's a good thing. But yeah, I mean, eventually I could see a lot of our borrowers becoming partner syndicates with us. I mean, we're already JVing with some of them on certain deals, still kind of on small scale. But eventually, why not say, hey, we have this opportunity, 250 unit building in downtown, wherever. And we're looking for 15 partners, and we're reaching out to you. And I would love to get to that day. And it always starts with a thought, right? It always starts with a dream. So I know that knowing Mario and I, that somewhere in the future, maybe it's usually within 5 to 6 years, 3-4 years average, we mention something and then we wind up doing it. And then it happens. And then we go, hey, remember we were doing that webinar? We said we were going to put together a syndication with our borrowers. We're freaking doing it. We didn't realize it. And we go, wow, we've done that so many times. So that's it. We just put it in the universe. Future borrowers, man, do good business, man, over the next few years. Ride this wave, COVID or not. The market will move no matter what. All right. It's going to go up. It's going to go down. There's always going to be opportunity to make money. We're here to help you in any way, shape, or form, whether it's advice or whether it's lending. And then eventually we'll get to different pastures, and who knows where our relationship will go from there. But I'm looking forward to it.
Yeah. Don't burn bridges. Remember that?
Don't burn bridges.
This is a small circle. And the higher you get in this game, and I can attest to this, the higher you game in this game, the less people there are out there.
You always run into that person that you pissed off, like usually unnecessarily. If you're given good advice and it's not coming from a place of malice, please take that good advice no matter how hard it hurts. Because we do that a lot. So this is coming from some things that have happened over the past couple of weeks, of course. We give good advice. Some people don't want to hear it. We pull the Band-Aid off quick and we tell you like it is. And we don't like to waste anyone's time, and we don't like to see people waste their own time. So if you got something and we tell you, no, you don't really have anything, you really should rethink this. You're probably going to hurt yourself. And you say, well, you're an idiot, and I don't believe what you say. Well, that's okay. Go forward, young person, and do what you got to do.
Best to everyone that's out there listening to us, guys.
Yeah.
Wish you the best. Through COVID, post-COVID, we hope to get to meet you if we don't know each other already. We hope to have these conversations if we haven't had them already. And ultimately, we hope to bring a whole lot of value to your operation, enough value to make a difference in your operation. If your operation is already going and you don't feel the need for value to be added, keep going. Keep going, and don't let anyone tell you that your operation is not good enough. But if you feel that your operation could use the extra muscle, the extra support, the extra brain muscle, the extra financial muscle, hit us up, and you know, let's talk. You don't have to be a borrower for us to talk.
Yeah.
And
Absolutely not. Yep.
we're quite accessible. My cell phone's out there. A lot of people have it. If you don't, just hit me up, and we'll get to have a cool conversation. Other than that, then, unless you have anything else to give out, I'm pretty much done there. I mean,
Yeah, me as well. Like Mario said, you know, just hit us up on Facebook if you don't know how to reach out to us. You don't have our emails. Just direct messages on Facebook. Mario Camino, Daniel Rivera, Adam Levine. We're very accessible. And then I'm just leaving our QR code up there. Flash a camera on that. Find our website, and catch us out in the field. Good luck to everybody.
bye, guys.
Make some magic.